Germany's SPD members elected a left-wing duo to lead the party, putting the ruling coalition at risk and raising the possibility of early elections. However, the new situation might end up with the government spending more to underpin growth. In any case, financial markets reacted favorably, equities rose, and interest rates recovered. Sentiment was also buoyed by China's PMI, which rose by more than expected. The mood rapidly soured when Donald Trump, as is his wont, took to Twitter to say import tariffs on steel and aluminum from Brazil and Argentina would be brought back. And doubts on a quick Phase 1 agreement between China and the US resurfaced when he declared that he had no end date in mind for a trade agreement and that it could wait for the 2020 elections. His administration stepped in to try to reassure markets, and equity stabilized. ISM indices in the US edged lower, but PMI advanced. Europe's definitive PMI data confirmed that the zone was stabilizing. With economic data stabilizing and/or improving, we have moved to make our global equity exposure more balanced. In fixed income, we prefer US short and medium-dated bonds, as they stand a good chance of rebounding and protecting portfolios. Yet again, markets remained in thrall to trade developments. Indices dipped at the beginning of the week as tensions resurfaced. Donald Trump said he wanted to reinstate import tariffs on steel and aluminum from Brazil and Argentina. He added that an agreement with China might well only occur after the November 2020 presidential elections. In a riposte to France's GAFA tax, Paris was also threatened with punitive duties on exports to the US and also had to contend with the World Trade Organization ruling on European aid to the Airbus A350 program. Positive remarks on a Phase 1 agreement before any new tariffs then helped markets stabilize. This was in spite of mixed macroeconomic data, notably a fall in industrial orders in Germany in October. In the UK, sterling's fall eased, but continued to weigh on sentiment. Oil prices rebounded after a drop in weekly US inventories and Iraq's decision to lobby for bigger OPEC production cuts. The S&P 500 was down 0.75% and the Nasdaq 1.3% lower as of last Thursday's close. Trading was marked by increased volatility after Donald Trump said a trade agreement with China could be put back until customs tariffs came into force on December 15th. U.S. 10-year Treasury yields ended the period at 1.79% after a risk-off episode saw them testing 1.7%. WTI oil was unchanged at $58.50 ahead of the next OPEC summit. Market sentiment remained nervous due to memories of last year's big sell-off in December. There is still a serious risk of overweight portfolio positions being unwound, especially by hedge funds. This concerns some tech and defensive stocks. Strong market polarization was also visible in ETF outstandings, with cyclicals close to all-time lows. Defensive sectors held up best in a down market. Consumer staples gained 0.55%, healthcare 0.3%, and utilities 0.5%. Led by large caps, Japanese stocks pushed higher, even if Donald Trump's hawkish remarks on his trade policies toward other countries occasioned some weakness. The Topix advanced 0.71% for the week. Economy-sensitive sectors such as iron and steel, marine transportation, construction, and metal products outperformed. Leading steel producer Nippon Steel and JFE Holdings gained 5.77% and 3.73% respectively. In contrast, Chinese demand stocks were relatively weak. Fast Retailing and Unicharm lost 4.47% and 4.24% respectively. Shiseido sank 4.11%. The Japanese government has decided on a 13.2 trillion yen stimulus package, or more than expected. Including private sector money takes it up to 26 trillion yen. According to the government office, it is expected to boost GDP by 1.4%. By 2021, key measures include a public infrastructure reinforcement spending for restoration after natural disasters, preparation for economic downturn risk, and investments in growth fields to underpin the economy after the 2020 Tokyo Olympic Games. The MSCI emerging markets edged higher this week, up 0.3% on a strong rebound of Brazil and Argentina, while Mexico, India, and Korea underperformed, down respectively 1.5%, 0.8%, and 1.3% as at Thursday's close. In China, November official manufacturing PMI showed a reading above 50 at 50.2 for the first time since April. Seasonal factors have largely played out in the rise as factory deflation remained. Non-manufacturing indicator came out at 54.4, its highest reading since March. A cautious tone indicated that monetary policymakers would continue to refrain from large-scale easing steps. However, some positive announcements came out from China's Ministry of Finance as it plans to issue special local government debt totaling 1 trillion renminbi to fund specific investment orientations, including the financing of infrastructure projects. Auto sales continue to be sluggish as the China Automobile Dealers Association estimated a double-digit decline, 10%, for the Chinese auto industry for 2020. That's all for today. Thank you for watching. Subscribe to our channel to track the market pulse and get the latest economic data.